Welcome, everybody. This is Kathleen Rogers. I'm super excited to be hosting with my good friend Jeff, who's a trusted lender here in Santa Barbara for over 20 years. We're super excited to pick his brain on how to finance your ADU. And Jeff and I have been working together for a long time, and we really appreciate, Jeff, everything that you and your team does for clients here at Zia Group.
Thanks for having me, Kathleen. I'm excited to share because it's definitely a topic that you and I have both been hearing a lot about. From state, county level, many people, the government's trying to push forward more housing units and trying to make it hopefully a little bit easier for all of you homeowners to add that ADU on your property. But that always brings up the question of, like, well, how am I even going to pay for this if I wanted to? So we wanted to make sure that we got that information out. So thanks for having me.
Yeah, it's a huge benefit, I think, to have an ADU, to have additional space for family members, additional space for friends who are visiting, and just additional space on your property. So it's really great. And there are also opportunities depending on what zone you're in for additional, income as rental housing as well. So yeah, it's going to be a really great topic.
And you see, Kathleen, just to kind of share some insights, when people are selling their house that has a permitted ADU versus a not permitted ADU, what are some of the conversations that you hear around that? Does it give much value to the house? Like, what do you see on that front?
That's a great topic. I was talking about just as a homeowner having the additional space, but definitely if you're buying a home, having the property that you're looking at have that ADU, not only just the potential for the ADU, but actually having that ADU built, it's a huge value add. And as a seller, when you are making your decisions, kind of thinking about what the benefit is for yourself as well as for future buyers. But yeah, I think a permitted ADU is definitely a benefit. And sometimes there's properties that have been around for a really long time. I had one on Veronica Springs this year that had kind of a second, it was like a 2-unit, but it was, 40 or 50 years old, right? So it was kind of grandfathered into the permitting process. So yeah, there are a lot of regulations, and if you're in Carpinteria versus Santa Barbara, there are different zones versus Goleta. So it's really good to think about what zone you're in and to consider that when you're planning your ADU as well.
Yeah, and that's something obviously that they can always get your help with, correct? If they're like, hey, you can help them do some research. Most of those answers you might even know off the top of your head because you're looking at places all the time and answering those questions. But if not, I think it's always important to understand that that's where Kathleen and her expertise and knowing where to go to find that information can save you a lot of headache and guessing. And I always discourage, in some ways, people use Zillow type products to kind of find places online, but what they forget to realize is how much extra information goes into making a good decision around a house being right for them. And Kathleen Rogers of the world have that information or can get it quickly. So lean on her for that sort of information. So
thank you for saying that, Jeff. We just had a meeting the other day with a really good friend of mine who's also a client, and as part of our investigation, I brought in some experts specifically around long-term permitting and what was possible. So yeah, that's definitely something that you want to do, and lean on a local market expert that really knows the local market.
Yeah, and something else that's got a lot of attention lately is the idea that you can build an ADU and then split your lot up and then be able to sell that second lot. So that's something that people are looking into. And just a quick headline on that is, if you do have your house financed and then you go to try to split your lot, you do need permission from the mortgage servicer to allow for that, because ultimately you could be knocking off value on the house that you have financed and them say no. Like, because if you have 80% financing on your house and now your house value of your lot goes down by 20% because you just took off a chunk of the lot for that ADU and sold that off, now that lender is 100% financed on your property, it might not go so well. So exploration there just is people get, you know, looking at all these in different ways. It's important to kind of understand where are the little barriers or who are other voices that you have to consider when you're making these decisions. So
Yeah, I would say this is not about lot splitting today. That's definitely something
yes,
that people are
correct.
thinking about.
Yep.
And there's pros and cons. And so, yeah, this is more with the intention of just how to finance it when you're keeping it on your property. I think
Right.
if you agree.
Yeah. Well, being that we're trying to keep it pretty short and then hopefully drive a bunch of questions to figure out what you all want to hear more about within this topic, let's get into the actual financing. How's
Do
that
it.
sound, Kathleen? And then please, you know, post your questions now or afterwards, send us emails, etc., and we can go through them, get back to you personally, because every situation, even in this quick conversation, you could probably figure out is so particular to you, and the general answers aren't always as helpful, but we're more than happy to dive into that for you. So reach out to us and we'll share our contact information at the end. So what I find is the most common way people finance. Here's the common financing solutions that I see people going forward with. Traditional HELOC, and we're going to drill into each of these and why they're helpful, okay, and why you would want to use them. So, Kathleen, please pepper me with things that I might be leaving out or what you've heard.
I love to share acronyms. So
Great.
home equity line of credit.
There you
HELOC.
go. Great. And then a fixed rate home equity line of credit. We've got a fixed rate second mortgage, which means it goes behind the first mortgage. We'll talk more about that and what that means. A traditional first mortgage refinance. And then there's a few other ways that we'll talk about. So that's high level what we're going to get into. So again, send notes if you feel like there's other ways that you were kicking around ideas and we can talk about it here today or answer your particular questions about it. But here's your acronym spelled out, like you said, Kathleen, home equity line of credit. And this is really the most common form of financing an ADU. Why it's so powerful, why it's so commonly used. ADUs tend to be $100,000, $200,000, $300,000. That'd be, have you heard any different than that, Kathleen, depending
No,
on
that
how
sounds about
big,
like, yeah, that's the
what's
range. I would say
what
that's the range.
yeah, what's already there, etc. And the reason why home equity lines of credit are so valuable and interesting is because they allow for interest only payment. They allow you to only pay on what you draw out. It's like a credit card, okay? But it's attached to the house, meaning the bank feels better about you getting a credit card attached to the house. If you can't pay it, then they're getting a house back versus nothing back if you can't pay your credit card. Okay, so this affords you a line of credit. Most institutions will allow you up to 500,000, even if you don't need 500,000, like we're talking about 100, 200, 300,000. You can go that high, okay? You can also, it's typically free to get set up, so it doesn't cost you any money. The rate is adjustable, which is a pro right now because they are tied to the Federal Reserve. So the federal funds rate, if you have been reading headlines, is expected to drop in 2024 and 2025. And so whenever the Fed drops their interest rates, your interest rate will drop exactly the amount that they drop theirs. Okay, so if the Fed says we're lowering rates by 0.25%, your home equity line of credit's interest rate will drop by 0.25%. Okay,
Automatically.
so while it might start high today, the expectation is that's going to be dropping quite a bit in the next 2 years. And so the rate will only favor you by being an adjustable rate. Okay.
And Jeff, is that tied to prime generally?
It's typed to prime, and then there's going to be some sort of margin for most
Plus.
of these on top of the prime. Okay, um, so yeah, prime is based on the Federal Reserve, federal funds rate, and then you've got that, and there's technically prime is 3% over the federal funds rate, and then you've got a margin on top of that.
And I always think of it as prime is like what banks charge each other to borrow money. And so maybe if I get a home equity line of credit, it's like prime plus 1. So
You
if the
got it.
prime is 3%, then that means my rate is 4%.
You
And
got
as
it.
the rates go up and down, I don't have to call and say I need to refinance then my rate of the borrowing money is also is adjusting.
Yep. Yep. That's perfectly explained. And what is so useful about these lines of credit is, and I note this, and I've already said it, but I think it's worthy of coloring out, is if you're building something, doing a remodel, building this, the time in which you need money is scattered out into the future. It's not as if you just pay the contractor $100,000, $200,000, they go build it. It's the contractor says, hey, Kathleen, I need $50,000 to get this going. Okay, we're done with phase 1. I need another $50,000 done with phase 2. Okay, we're on to the last phase and we need another $50,000. So what's nice about these lines of credit is you only pay, again, interest on the first $50,000 until you need the next, and then you're paying interest on the next. So it allows you not to have to pay all of the money or interest on all the money at once. And maybe you're even doing like work with an architect, and the architect needs 10 or 20 grand, and a designer and whatever else. So it's really useful because again, it plays out over months' time, and you're getting permitting, and you don't really potentially know when you're going to need all the money. And so this allows you access to it when you need it, but not paying interest on it until you need it. So the cons though about this is some people want principal and interest payments. They want their hand forced to pay back the loan. So if you just pay interest, you're not ever paying down that loan. And that might be a con for some people. The process takes 30 to 45 days. That might be a con because you're needing the money. You realize like I'm actually getting going tomorrow and I need to pay my builder in a week. And now I'm hearing about this all now, or realizing the contractor came back with a bid much higher than expected, and I need the money, and I need the money right away. And waiting 30 to 45 days might be a hindrance. So adjustable rate, if you're someone that's a nervous Nelly about where rates are going, or someone that really believes in inflation's still not in check and rates are going to hold higher for longer and maybe even have to go up, like that might be a negative for you. The future will tell us whether that adjustable rate is positive or a negative. One of the cons to these types of home equity lines of credit is you're qualifying for this line of credit like you would for a first mortgage. So if you've been through the first mortgage process, you know it's a lot of documentation. It's a lot of looking under the hood by their underwriting. Half the time, and these, or most of the time, they're doing a full appraisal. So there's time, there's paper pushing, all that stuff that's not as always experienced well. And that's why the 30 to 45 days. And most credit unions, most banks, etc., are going to only allow for these on primary residences. Can you get them on investment properties? Yes, but they're few and far between. Okay, so that would be the pros and cons of these home equity lines of credit. Anything that's coming to your mind, Kathleen, that makes you think when you hear this all?
Yes, I think it's important to just when you own a property and your property value increases, one of the benefits of owning, one of the opportunities of owning is that it's your home. And if you look at home ownership, you're building equity in your home. So a home equity line of credit it's basically you're taking your, let's say you bought a home and you paid $400,000 for it, and now the value of your home is 800,000. So you have equity in your home. So a home equity line of credit is you're borrowing money against the value of your home. So it's not something that you can do if you don't own your home. And you need to have equity in the home to then pull money out, and you're basically paying yourself back with interest when you borrow against the value of your home. So I think I just wanted to just
Yep. That's
explain
great.
that at
That's
a bigger
really
picture.
important. Yep. Yeah, that's the power of home ownership, right? And you
Yeah,
get
so
it for
you
much
have a place.
cheaper than that credit card.
Right.
Yeah.
It's prime plus 1 or 2. Imagine it's, even if it's like 7%, right?
Yeah.
I mean, that's not 26% on your credit card or 18% on your credit card. And you're borrowing money from yourself and you're paying yourself back. So you do need to have equity to have a home equity line.
Love it. Love it. Yeah, so that's definitely the conversation here is and all of these are going to require that you have 20% equity after you get these lines of credit. Okay.
That's what made me think of it, because you're up to 400K available. That's an assumption of that you've got 600 or 700 or $800,000 equity in your home, right? If you have $100,000 equity in your home, you still maybe could get a $50,000 home equity line of credit. So yeah, you need to have that level of equity in your home.
Yeah.
And for all of the friends who have been in their home for a really long time, and you have a lot of equity in your home, this is something that you can think about. Maybe thinking about a family member that's going to be retiring, or college kid that's going to be coming home, thinking about, hey, I want to be in my home. Yes, I'd love it if you want to sell. I'd love to help you sell. But if you want to stay in your home and you have a big backyard and you want to have some flexibility in your space, maybe a home office, a home equity line of credit could be a really good option. And then Jeff's going to talk about another kind of home equity line of credit.
Yeah, so this one's a little different in the sense that it's fixed rate. So if that's something that you really believe in and you believe interest rates are going to be going up, a fixed rate HELOC might be the way to go. These are automated. So this is like one of the products that we have here where you just fill in your name, your application, and it's like based on the information you filled out, you're likely qualified. Now we need a few things uploaded into our system. It's all automated, and you can get your money in as little as 5 business days. You get all of the money at one time. Once you pay it down, you can draw back out. So that's where it still remains a home equity line of credit. They just require that you take all the money at once. You end up with the fixed rate. There's no appraisal done. It's all through the automated. And then you can get up to 400,000. You can do it on primary or investment properties. So a lot like the home equity line of credit, with a few nuances, a little less money available. You can go into the investment property that you can't on the typical line of credit HELOC. But some of the cons though is it's more expensive because they're doing this all automated, so they're not looking under the hood as much. They're not doing an appraisal, so they're taking more risk there. And the reality is those points just get drawn into the loan amount. So it's not as if you're paying money out of pocket, though it's still money ultimately you will pay. The fixed interest rate is a negative in a lot of minds right now because I follow Wall Street's kind of big bet that the stock or the federal funds rate will be going down. So I look at it as more of a negative. You getting all the money at once is more a negative. If you don't need it within the next 30 to 60 days, I would say that's more of a negative. If you need it drawn out over 6 months or something like that, probably better on the home equity line of credit. And then principal and interest payments are required. So again, if you're trying to keep your cash flow high, meaning as low a payment as possible, even though you're not paying down principal, that might be more valuable to have your cash flow higher than to pay principal and interest and pay that loan down over time. So pro and con there. Each of these have their pros and cons in some ways, but it's important to be kind of aware of which side of the fence they probably fall on. But really, the great piece about this is even if you're like halfway through your ADU, you're already started, and you realize you need more money, and you never got a line of credit, you're going to pay all cash for it. You're like, we're running out of money, and we need another $50,000 or $100,000 to work through the final half of this project. This is a great tool for you because we don't go in and look to see what shape the property is in. We're just doing an automated appraisal, and can get you your money really quickly. So those are the pros of something like this versus the typical home equity line of credit that again is going to take 30 to 45 days.
And I think if it were me and I was talking to a client, I would say the benefit of this is that you get your money really fast, and also you can use it for an investment property, not only your primary residence. And there's no appraisal, it's very quick. The traditional home equity line of credit, I mean, it could be even 3 months process to so I think it just depends on your situation. But I think the big con is, let's say you're going to get $100,000 or $200,000. If you do the quick one, you're getting all that money right now. It's like sitting on your side of the fence. So you're making your payments on $200,000 immediately. You may not be paying the architect for 8 more months, right?
Yep.
So you're kind of paying on the money right away, versus the traditional one, you may only pull out $20K of your $200K. And so you're making payments on what you use versus all of it at once.
Yeah, if you need money for like the actual permitting process, the architects and permits, etc., it's probably best if you can qualify for the home equity line of credit, the traditional one, because again, that permitting process could take a year,
Right.
And you don't want to be sitting on $200,000 for a year of interest.
And Jeff, is it possible to have multiple? Could you have one of each on the same property, or no?
They both want to be in the second position behind the first mortgage.
That's what I thought you were going to say.
Yeah. And so let's talk about that. The second position, what that really means is if you were to fail to make your mortgage payments, your first mortgage payments, okay? The first mortgage provider is going to go and say, hey, you've got however many months to write this, and then we're going into foreclosure, and then, the proceedings go through. But whoever's in second position, they're the ones that get paid second. So the first mortgage gets whatever money remains from the sale of the home. They get paid out. If there's sufficient funds beyond that, then the second mortgage gets paid. And hopefully there's sufficient funds to pay both of them. Okay. But if there's not, that's where the risk of the second mortgage is they're taking on that risk. They don't have the ability, they don't have the right to get much money. And in the 2008 crisis, that's what happened a lot, is second mortgage providers got, essentially the first mortgage said, we'll give you $10,000, even though you had a $100,000 line of credit on this property. We'll give you 10, you go away. We were getting less than we thought. And it is what it is. So that's why second mortgage, if you're in third position, which every once in a while I do see clients somehow secured a third position mortgage or personal loan or something connected to their house, you're the third in line to get your money paid. Okay. And property taxes, if those aren't paid, go in front of the first mortgage. So long story short, everyone's jockeying to be the most preferred person to get paid back first if things go badly. Okay. And I think it's always important to say banks do not want to take your home back. Like, that is not the intent of giving you the loan. They just want to make sure that if that happens, comes to it, that they have the money or are in a position to do that. Okay, so fixed rate second mortgage. Okay, so where these are useful, and pretty much the only use that I'm seeing right now, is self-employed borrowers that write off a lot of their taxes despite earning income. We can do a business bank statement qualifying loan, so you can qualify based on your bank statements. So we can look at your revenues coming into your business bank account and then qualify you based on that. That's really nice to be able to qualify that way, because the first two products that we just talked about don't allow for you to do that. So you might get told no on the traditional line of credit, told no on the automated line of credit, the fixed rate, and now you're like, I still need this money to do this ADU. So we still have a great tool for that, and that's this fixed rate second mortgage. So
Can you
um,
clarify that, Jeff? If you're
yeah,
saying if someone for some reason was not able to get a home equity line of credit, that they could still get a fixed, basically a second mortgage on their home?
yeah. So one of my clients runs a business, and on her tax returns, it will show, $180,000 of annual income, which wouldn't be enough for her debts, okay, to qualify with this new line of credit that she needs to build out her ADU. But if you look at her revenues for her business and how they qualify people with just business bank statements, she's making 80 or $100,000 a month of a qualifiable income. So she's more than qualified when you look at it that way.
Got it.
So that's a really nice way to help people. And we use that a lot on the first mortgage front for self-employed, which, stick around. We're gonna have another conversation on the self-employed qualifying borrower front. But we'll keep it short here. Just know that that's possible if you're self-employed and have been told no by your bank, by a credit union, by whomever, that it doesn't work to get a second mortgage when you might need it. This comes with fixed interest rate. Again, there's positives and negatives to that, depending on what side of the fence you are about inflation and where the Fed's going. You get all the money at once. Again, when you're getting all the money at once, you're having to time it more accurately. You can't just get all the money. And then you have the principal and interest payments required. Okay. The cons, again, more expensive. So typical first mortgage refinance cost plus 1.5 points. So if you're getting $200,000, you're looking at $3,000 in points, and then you're looking at another, $2,000-3,000 in refinance costs. So you're around $5,000-6,000 to get this line of credit, which, again, still way better than a credit card. But ultimately it's not as appealing as option 1 or 2 if you can qualify for those. And then so yeah, get all the money at once. So all the pros are kind of the cons in this as well. So any questions about that? I think okay, so that's all self-explanatory. Here's another option that I see people look at. Definitely way more common a few years ago, is just let's say you have $1 million house, you have a $400,000 loan on it, you need $200,000 to do this ADU. You just do a new refinance of $600,000. So that's $200,000 between what you owe right now. You get a $600,000 loan. That means you'll get $200,000 or so in your bank account. Okay. And now you've got a one loan. So it's first mortgage. You got one loan, one payment, and you have to pay it back in 30 years. Principal and interest typically. And that's really nice because you have everything buttoned up in one fixed interest rate, and nothing's moving, and the interest rate's the lowest that you would get compared to the other options we've already talked about. Where people are shying away from this right now is because their $400,000 interest rate is likely in the 3s or 2%. So why am I going to go get a 7% or 6.5% loan and get another $200,000? Now I'm wiping away that 3% interest rate on my 400,000 and getting a full 6.5 or 7% on the new mortgage. So that doesn't make a
Right.
whole lot of sense. Okay.
So for folks who are buying homes now, in a couple of years, when rates come down, this will pick up again, where
You
people
got
want
it.
to they're going to refinance anyway, right? You're going to refinance
You
anyway
got
to
it.
go from 7% to 5%, let's say.
Yeah.
And so a couple of years from now, you might say, should I get some extra cash? I have more equity in my home. Maybe I can afford a little bit more of a payment, plus my interest rates are going down. So I bought my first house at 29 and I paid student loans for 10 years. And then when I refinanced my house, I actually pulled enough out to pay off my college debt.
It's fantastic.
So again, I
Yeah.
used my own home to pay off my college debt. So
Yeah.
this was a long time ago, but again, another value of being a homeowner.
Yeah.
If you can do that, and it's not easy to be a homeowner, you have to work really hard and make it work. But yeah, I think we're not seeing it now because if you have a 3% interest rate, you're not going to want a 7% interest rate or a 6.5% interest rate. But
Yeah.
I think
And
for people who've recently purchased, I think this is something to be thinking about in the future.
you got it. And the only person I would say, a homeowner that I would say this still would make sense for today over option 1, 2, or 3 is how much money you have, let's say $100,000 first mortgage right now, and you need 2 or 300,000 to do this ADU. Okay, so now the 100,000 smaller than the money I need. Okay, so I can do a quick. What we do is we put $100,000 at 3% and 200,000 or $300,000 at 7% or whatever, and do a weighted average. Or I'm sorry, the home equity line of credit is going to be at like 9% or 8.25%, the other option. So you do 2 or 300,000 at 8 or 9%, and the 100,000 at 3%, and get a weighted interest rate average. Okay, that might come out to be 8%. Okay, between the two loans, when you blend them together, if you got a first and second mortgage together, your total interest rate that you're paying on all your money is 8%. Okay. Well, if I can get you a cash out refinance for 7%, okay, and not do that combo, then you're a percent ahead. So it really matters how much you have in that first mortgage and how much you're needing compared to how much you're needing for the second. Sometimes it still makes sense, but not often. Okay.
Can I ask you a
So,
question?
yeah, go ahead, Kathleen.
If I understood you right, I don't think I did. If, so for folks who've maybe been in their home, we're talking about Santa Barbara people, but this is for everybody.
Yeah.
But you have a low mortgage and maybe you could pay it off if you wanted to, but you choose not to pay it off because you like the tax write-off or for whatever
Yep.
reason. So you have a very low amount that you owe on your home. And now you want to add an ADU. And so the ADU cost is more than even that you owe on your home. So you could do a cash out refinance and maybe not care about the interest rates so much. But my question is, did you say that you could still keep your 3% interest on the 100K? I didn't think so. Yeah. So you're not, so you're
You could if you,
refinancing. It's a regular refinance. The whole thing
for
is getting
this,
the new rate.
you
And
got it.
but the second thing is, the thing I love about working with you, Jeff, is that you are really good at making a table with all the options
Yep.
and then saying, this is option 1, this is option 2, this is option 3, and looking at people's unique circumstances and what their numbers look like, and then making a decision as to which one is best.
Yeah, I'm definitely a believer in numbers, having numbers on the page rather than speculating.
Right.
Side by side, usually the homeowner has a gut response immediately to this feels right, this is best, this is whatever, right? And that's what's really helpful. I mean, emotions are always playing a role in what decisions made, but having that, here's option 1 where you keep your $100,000 at 3%, get a $200,000 at 8.5%, and what that payment looks like. Pros, cons. Option 2, here's just getting a $300,000 first mortgage at 7%. Here's what that payment looks like. Here's what these costs look like side by side. And it's exactly it. Like, our goal is to be your information gatherer and like clear understanding of what's possible are, and then like and then a sounding board, right? Like, okay, here's what's available, here's what seems to be best, here's what we're seeing, why we're seeing people like option 2 or 1 or whatever. But ultimately, you're the one making the decision. So if we can educate you around why they might be good one way or the other, that's why we're even doing the pros and cons today.
Right.
That's the goal. And I love that. Yeah, I mean, it's the blended rate is something that most people don't know about, but it's a helpful tool that I can help you with if that's something that you're trying to figure out. And
If you
usually
replay
it's
this
pretty
later and
obvious.
if you replay this later or share it with a friend and you want
Yeah,
us to kind of run through your numbers, don't feel like you have to pick one of these right now.
you got it.
We can
Yeah.
help you run all the numbers.
Yeah, well, and the last thing we didn't talk about is cash out refinances have unlimited. I mean, different investors will have like you can only take 300,000 or 500,000, but we have investors that will allow you to be unlimited cash out. So that's really can be a really important tool, less so on an ADU and more so on like a full remodel, but just something to keep in mind that it just there's more expanse to this cash out refinance than some of the other options. The cons will go back to these fixed rate that we're talking about, right? You're getting a fixed interest rate, you're having to pay principal and interest most of the time, though you can find interest only options. You get all the money at once, so you really need to know when you're going to spend it, how much you need right away. Most of it you're going to want to be spending pretty quickly. And we already talked about like you'd be replacing a first mortgage potentially that'd be much lower. So we'd want to figure that out. So cash out refinance, very common, always worthy of looking at, just as like, even again, like we were saying, it might be a quick, easy no, but it's nice as a guidepost to see, and definitely will become more valuable in the years ahead, like Kathleen mentioned. Other options, and I actually failed to put one on here, but you can get a line of credit against your stock portfolio. So it might be one of those things where you go to Merrill Lynch or Schwab or whatever and say, hey, I want to get a line of credit based on I've got $1 million in stock, and I need 200,000. A lot of people have been paying all cash to buy homes this way. This might be a way to get reasonable priced money without having to qualify, other than your stock portfolio, and to be able to then draw out the money as you need it. Those are adjustable rates, so it's always worth figuring out if the rates are right, but could be a nice solution for you. I don't believe they charge you any money to do it. So that's a really nice thing. Personal loans, they'll go up to 50,000. They're not going to be placed against your house, but you could get it if, again, like you're on the last stages of completing a remodel or the ADU already, and you're like, I just need 20K. I've already maxed out my credit cards. Like, I
Right.
need a little bit more money. The interest rate's going to be higher. It's not placed against any property, but it's a solution. And then the last thing would be that I didn't put on here would be a reverse mortgage as a line of credit. So if you've got no loan or a little bit of loan on your property, you're not going to be passing this down to anybody, but you're like, I'm going to be in here for another 20 years and I'd love to, build an ADU so my daughter or son can live on the property, or I can live in the ADU and my kids can live in the front, and you don't have any ability to qualify for this other stuff. Reverse mortgage, if you've got equity, and have been paying your property taxes and insurance on time, um, you can get a line of credit, and then you could draw out the money and pay the contractor as things get built out. So,
Good
and
addition.
the only other thing I would add to that is you have to be of retirement age, so
I
62
was
and
gonna say, yeah, this
yeah.
is like for someone who's retired. Yeah.
Yeah, so
Yeah.
reverse mortgage, but that would be the most expensive option. It might be the only option, and it might be a really useful option again if you want more space on the property, and you're not the other options we talked through won't work out. But anything else you're thinking of, Kathleen?
I think, no, I think you did a great job covering those.
Great. Okay, so last little
And we know a
thing.
lot of great, I just want to mention that if you
Yeah.
are thinking of an ADU, there's a lot of moving parts. There's a lot of great resources, professional service providers. So love to make connections and introduce people to some of the, great service providers in the area. So again, reach out to us for any kind of questions that you might have.
Yeah, yeah, and more specifically on that, you are going to want to talk to a contractor as soon as possible to figure out what is the scope of this. Is it 100,000? Is it 200? Is it 300? And then it might be, okay, 200. I should talk to Kathleen about what's the likelihood I could rent this out for 1,000, 2,000, 3,000, $4,000 a month, depending on what quality. Okay, okay, it seems like it's starting to make sense. Like, okay, who's a great architect, Kathleen, that I could talk to, right? And then what's the
Got you
time
covered.
frame? You're right, and permitting process. So these are the things that you're gonna want to start working on sooner than later. And then you got a good enough idea on numbers, and then you go to someone like myself, and go, hey, Jeff, okay, we know it's gonna be about 200,000 best guess right now. Let's talk through these options that we just went through to figure out what's going to be the best for us, given the amount of money, given how much equity we have in the house, etc. So a lot of people have been having success with these, but it is a dollars and cents thing that you gotta really figure out of like how long does it take to pay yourself back for the expense, because it can take some time. And construction is expensive. So
And you're increasing the value of your property.
yes, yeah. And so that's one of those things too, that yeah, long term, like it is a great value add to your property, and trying to figure out, can you get to the end? Like, is that part of your plan? And any way that you can find ways to better your property over time, and everyone wins eventually. So
And you're get to enjoy it, right? So it's not about adding value to your property to sell it necessarily. It's also about adding value to your property that you can enjoy while you're living in your property.
yep, exactly. All right. Well, that concludes our conversation today. We'll pause here. We're gonna turn off the recording, so personal questions and stuff can happen without you feeling the need to feel like you're getting recorded and hold back on your question. So
We're going to turn off the recording, and then here's our contact information, my cell phone that ends in 5077. If you have any need for experts or questions after this, please share this with anyone you know that might be interested. And Jeff's contact information is here as well. So we would love to hear not only questions now after the recording is turned off, but please reach out to us when you get a chance to watch the replay and share
yeah,
it.
thank you so much for listening, and we hope it was helpful. And yeah, thanks, Kathleen. Thanks, Zia Group.